In the past 6 years, we've been experiencing an economic recovery and expansion, but for the first time, there's some uncertainty in it. I think in the past, every time we've taken a look forward, it's been a pretty clear path that the economy may be a little bumpy, but it's still in pretty good shape. But right now, we've got a lot of balls in the air. Number one, on the good side, we've got energy prices, and we know that we've seen a dramatic decline in the past few weeks in the price of oil per barrel. We know that that decline in price, along with a return to the normally formulated blends of gasoline that we see in the fall and the winter, are going to mean gasoline prices are probably going to drop 50 cents over the next 3 months or so. And that's good news, because a 50-cent decline in gas prices will effectively it's like getting a 1.5% increase in your income after taxes. And consumers are going to have that increase in their discretionary income, and they can spend it on all different kinds of segments, or all different types of segments of the economy, and that'll be good for the economy. And we know that's probably going to happen, pretty good certainty that's going to happen. Kind of on the negative side, and we don't know what's going to happen, is what's taking place in China right now. We've got a situation where a big decline in their stock market. Their GDP has slumped a little bit in the first half of 2015. Not dramatically. They're still growing at 7%, and we'd give anything to grow at 3.5%, half of that rate. But still, 7% for them after almost 8%, 7.7%, 7.6% over the past quarter, the quarters prior to that. 7% is a little bit of a problem. Couple that with, and again, that's the first and second quarter of 2015, couple that with the big decline we've seen in their stock market in the last 3 or 4 weeks, makes the Chinese economy a little bit uncertain as to what's going to happen. And then the final wild card that's out there is, of course, what the Fed's going to do in September with the interest rate. The question is, will the Fed take this opportunity at this point in time to start to restore some normalcy to interest rates in this country? And that is, will they raise the interest rate in September? If they do, it's only going to be 25 basis points. So I really don't think it's going to make a big impact on the consumers. I think the real issue here is the Fed being able to create some maneuvering room for a year from now, 18 months from now, if the economy slows down, their ability to then say, oh, we've got some headroom here, we can lower interest rates to try to stimulate the economy. Right now, they don't have any maneuvering room. If the economy were to get sluggish right now, they have no ammunition, they have no tools. And so I think there's a desire for them to do that, despite the fact that there's call from a number of, I think, respectable organizations and individuals. This isn't the right time to raise rates with all the uncertainty in China and all the uncertainty in Europe, and the ECB announcing last week that they're going to engage in another round of quantitative easing. I think it's probably time to do it. So I'm of the opinion, just barely, that we'll see a rate increase.